decline. But based on the transaction prices, as well as the income, you took a bigger fall, and you've had a bigger recovery, but you're still below. But this iceberg fund, using the derivatives, hardly had any negatives, even in the worst of the downturn, and you're over $160 now for your $100 investment. So this is the kind of thing that can happen with these things. Now, so that's kind of what I'm going to say about derivatives. Keep it in mind. Keep that in mind that that's one of the things that these kinds of indexes can be used for in the future. They really haven't been used much to now in that way, and I think that we still have a few years to work through, development of Dodd-Frank and everything before it's really part of the fabric of the industry in the U.S. here. But I think it's definitely going to happen. It makes too much sense. It's too useful. It will happen. But these indexes are also very fundamental information products. So quite apart from tradability or not, and actually our original motivation at MIT, it was really information. So let me just give you a little bit of we'll go quickly through a sort of fun with indexes, we can call it. This is, you go back to 2005, and there was only one index tracking the U.S. institutional commercial property market. This is the NCREIF index based on appraisals. This is the TBI, the transaction-based index that we developed, and you can see how it shows more, more cycle amplitude. It rises higher. It turns quicker, sooner. It's a leading indicator of the NCREIF index because transaction prices are actually where the action is, and then appraisers kind of look at that, and they kind of, through a sort of a fuzzy glasses, they kind of smooth out with a bit of a lag. Notice that we've had a 19% recovery in the prices in the TBI since it bottomed out. The third index, or the second index we developed, the CPPI, the repeat sale index, this is based on that broader population, all the property sales of more than 2.5 million. And it's literally directly tracking the actual experiences of investors, the round-trip experiences. Because a repeat sale index, it's a buy and a sell, and the difference in the pricing between that buy and the sell of investors who've actually sold. So this is reflecting the actual realized experiences. It's the neat thing about a repeat sale index, and makes it very comparable to a stock market index in the sense in that way. What we've seen, interesting here, is the index bottomed out in late 2009, but it hasn't really been able to take off since then. And this is because it's an equal-weighted index, and it's being weighed down by distressed sales. And the fascinating thing, and we can drill down with this data and do repeat sale indexes on segments. And what's happened in this downturn is a fascinating segmentation of the commercial property market, the institutional commercial property market. Properties over 2.5 million has first bifurcated into distressed and healthy, and then trifurcated into distressed, trophy, and other. And the distressed properties, of course, are selling at a much lower price point. And so depending on how much distressed sales are in that index, they can hold the overall index down. But what we can see by drilling down is that there's a whole other segment of the market that has really taken off. And these trophy properties here, which are properties greater than $10 million, not distressed, and located in the top-tier cities that have really attracted the capital, these guys are up. They're up 35% from their bottom at the end of 2009. So this is the kind of thing that we can track with these kind of indexes. We call it, trophies trash since the crash. We can drill down other ways. Here what we're looking at is big properties versus small properties. So again, this is within the Real Capital database, so this is all properties of at least 2.5 million. But the black line is properties that are no greater than 5 million in terms of their prior sale price. The red line is properties at least 10 million prior sale price, and the orange line is properties at least 30 million prior sale price. So that orange line, those are really big properties. They have an average price of $95 million in the second sale price. And what you see is a substantially different behavior. The smaller properties really have not bounced back, but they didn't fall as far, and they may have had a slightly higher peak. So even though the big properties have bounced back a lot more, we call the big has bounced back 24%, the super big have bounced back 35%, but that doesn't mean that they're actually higher relative to their peak than the smaller properties, which haven't bounced back, but didn't fall as far. And that this is a story of different kinds of sources of financing. Right? The smaller properties rely more on regional banks, local banks, which didn't totally dry up in the downturn, like the non-bank financing, but on the other hand, have had haven't been able to tap into the bounce back in the private equity world and the non-bank financing that has happened in 2010 and REITs and so forth. Well, speaking of REITs, here's a sort of a just for fun thing, because you don't want to necessarily, you want to take this a little bit of grain of salt, but the blue line is repeat sale index of all REIT properties. So REIT properties, the sales of REIT properties. The red line is CMBS properties. And these are two pretty much separate populations, a little bit of overlap, but hardly any overlap. So the red line is properties that had been financed by a CMBS loan. The blue line is properties that were owned by their, obviously, at least their equity financing by REITs. And what you see is a little bit of a tortoise and hare story. The REITs didn't bubble up as much during the bubble, but they didn't fall nearly as far, and they bounced back quicker and sooner. So this is, I think, partly a story of leverage, right? The CMBS allowed much more leverage, particularly during the boom, during the bubble. The stock market kind of kept REITs in more discipline. So I don't know, it's just for fun. Here's another way we can break things down between supply-constrained and non-supply constrained markets, CBD versus suburbs. And what you see here is what really stands out is supply-constrained CBD properties really grow. And this is just price change. It's not total return. But definitely more price growth up to the peak, but greater volatility, a bigger drop during the downturn, but then a really big and impressive recovery since then. So it's another interesting way to carve things out. This is just non-residential properties, but we also have an index that tracks the residential in particular, and that's been the segment that has grown the fastest. It's bounced back the most. It's bounced back about 20%. I think I'm being pulled off the stage here, but this is my last slide. This is really the most important slide. This is Boston versus New York, and had to do this. I was disappointed at the result. The green line is Boston, the blue line is New York, and the red line is actually the Manhattan component of New York. However, it is scientifically provable that we do have better sports teams. So I'll leave it with that. Okay, sorry if I went over, and looking forward to the rest of the program. Okay. Okay, 2 questions. Yes, sir.
These indices are obviously based on different, the components of these, have different inherent risk in them. And has any research been done on pricing models and, for these different?
Yeah, there's been a little bit of research on pricing models, and it's kind of fascinating. It doesn't uncover any very clear or rational results. It's hard to come up with a pricing model that both well explains the differences in returns that's related to a definition of risk that really makes sense. So it's an interesting either conundrum about maybe we just don't have enough history or else maybe the market really doesn't, this kind of level of information is so new. The market maybe actually doesn't yet know how to digest this and feed it into the pricing, which would imply that there's a lot of opportunities out there. Yeah. One more question. Yeah.
Just quickly, who's the market maker for the derivatives market? What's the size? How big is that?
Yeah. Geez, I don't know how big the Reach Fund is. It's not huge. I think it's a few $100 million. But the market makers have been the if you want to call them market makers, these things have been trading over the counter, and the dealers like Goldman Sachs and Morgan Stanley and J.P. Morgan, I think those are the three that are still in the game. They've been, in some sense, trying to make the market in the sense that they'll do a little bit of warehousing of a long position before they necessarily have an exactly matching short position, so they'll take a little bit of risk there, but they're not really trying to be in that business, and so there isn't really an institutionalized market maker like if you had a clearinghouse or something like that, and that's been one of the problems. Yeah. Okay, well, I think we'll cut it off, and I'll...
Thank you very much, Professor.